Hi everybody, and welcome back to video number 4, our last video on chapter 1. And when we left off, we were looking at how we prepare financial statements. And a quick review is that we prepare these in a specific order: income statement, statement of retained earnings, right? Balance sheet, and statement of cash flows. Our income statement, very easy here. We take our revenues minus our costs and expenses, and we get net income. One of those expenses could be tax expense. So net income is after tax. And then our statement of retained earnings, when we roll the net income at the end of the month into the balance sheet, into the equity section in retained earnings, you will see that we've added that net income here. Dividends, kind of a funny account. It lives in the statement of retained earnings. It's not an expense. So we start with beginning retained earnings, we add net income, which is the difference between revenues and expenses. And that means expenses, we increase expenses but reduce net income. We increase revenue but we increase net income. Okay? And so then after we add net income and dividends together to get ending retained earnings, that ending retained earnings then we roll down into the balance sheet, which I'll show you here in just a second. So here they are. Here's our revenues, $6,100. Here's our expenses. We only had 2 of them, $1,700. So we subtract them, we have $4,400. And that's at the end of December. So we roll that balance down to the statement of retained earnings. And we'll go through this when we have our closing entries. But right now we do that at the end of the period. We roll that net income into the statement of retained earnings here. And we add that to beginning retained earnings. In this case, we didn't have any because Fast Forward just got started at the beginning of December. And then we subtract out the dividends, and we are ending up with $4,200 of retained earnings. So then we roll this balance down into the balance sheet. We bring down all the ending balances of our assets, all the ending balances of our liabilities. We only had one, accounts payable, and that left us with the $30,000 in stock plus the retained earnings, gave us total equity of $34,200, and as you can see, the total assets equal total liabilities. All right, now once we have that information, we can prepare the statement of cash flows. I'm not going to spend a lot of time on the statement of cash flows, but here we have our operating activities, our investing activities, and our financing activities. Our operating activities are generally that's 90% of the transactions. That's when we pay our expenses and we have wages expense and rent expense and all the expenses we have and all our revenues. All of those are generally short-term in scope. Short-term liabilities, short-term assets, and expenses and revenues. So, as you can see, we only put in when we actually receive the cash from clients, and we only reduce the cash when we pay for those expenses. And that left us with cash provided from operating activities of $1,000. Investing activities is where we purchase long-term assets. It's not where we're buying stocks and bonds or things like that. We're kind of investing in ourselves. We're buying long-term assets like cars and trucks and buildings, and we call that PP&E, property, plant, and equipment. And in this case, here's the equipment. It's a reduction of cash of $26,000, but we also got some cash invested from our stockholder for $30,000, but we paid a little bit back to that shareholder in the way of dividends. Dividends are periodic cash payments that we make to shareholders to reward them for being an investor. And so we take all 3 of these pieces. We get a net increase of cash of $4,800 in this case. We didn't have any cash to begin with because we were just starting out our company. and our cash balance, therefore, was $4,800. And that's all for financial statements. So one last thing is return on assets. Whenever you see this term return, that's almost always net income divided by something. So in this case, that's exactly what it is. It's net income divided by average total assets. And how do we get average total assets? We take the beginning total assets at the beginning of the year, and we take the ending total assets at the end of the year, and divide it by 2. Just that simple. So return on assets then is a they call this a ratio, but really it's a percentage. As you see here in these examples for Nike and Under Armour, this is the return that we get on the amount of average total assets that have been invested in the company. This is a key metric that investors use to evaluate a company. And so that ends Chapter 1. And when we return, we will continue with Chapter 2. Until that time, bye for now.